Sheila, it's great to see you, and I don't typically think of you as an inflation hawk. So I think the fact that you are saying, look, we may not even peak until 2023, to me is quite striking. How do you see this playing out?
Well, I am very concerned. I think the Fed's being a bit optimistic about this. For one thing, home prices, which have gone up dramatically, housing prices, because of technical reasons, those numbers don't flow through into the inflation measures for some period of time. There's a significant lag. So those are not fully reflected. I don't think those will be fully reflected probably until the first quarter of 2023. But housing prices have gone up. They were up 20% last year, 10% the year before, projected to be another 8% this year. That is not yet fully reflected in the inflation numbers we're looking at. Also, energy and food. We had global supply constraints already. And with the Ukraine war, those have been severely exacerbated. Energy in particular flows through to everything: transportation costs, processing, packaging. And then, of course, the agriculture commodities themselves. The Black Sea ports are shut down. Ukraine's a significant exporter of agriculture commodities, especially in the Middle East, where we're already seeing some food insecurity, significant issues. But again, the market should correct and stimulate production elsewhere, but it takes time for the markets to react, to reallocate the acreage to increase oil and gas production in other countries. So, yeah, I think we haven't even started to feel the full brunt of that, and that it's going to take some time. I think 2023 is much more likely to be when we see the peak. I think it's also important not to overestimate the effectiveness of the Fed's tools in combating inflation. A lot of it is demand driven through fiscal and monetary stimulus, but these supply constraints are very real and very difficult for the Fed through the lever of interest rates to address.
Well, you have a lot less stimulus coming into the system, a lot less dollars from the federal government and also from the quantitative easing. But what you seem to be describing, Ms. Bair, is my word, not yours necessarily, are bubbles. Bubbles in housing, bubbles in oil, food, markets, bonds, stocks. Bubbles don't usually end well.
Yeah, well, when it comes down, it could come down quickly. And monetary policy has inflated. Right, we have an everything bubble, so it's particularly acute with financial assets, stocks, and bonds. That's definitely been a factor with commodity prices, real estate prices, both commercial and residential. So yes, over time, as interest rates go up, those valuations are to correct, and that's another real danger with what the Fed is trying to do now. Remember 2004 to 2006 when the Fed was raising rates at about the same pace that they're predicting now. That finally that popped the housing bubble. By 2008, we had a real problem. Now we have an everything bubble. So I do think the Fed needs to be very careful on this. I would not be too aggressive. I would err on the side of living with a little more inflation than precipitating another financial crisis, which would bring recession and would bring a lot of hardship for a lot of people.
Yeah, I mean, the cliche is that the Fed wants to achieve a soft landing. That's what it always wants to do when things get...
Right.
But would you say the odds of that are long?
I think they're very long. Yes, they're trying to both raise rates and shrink their portfolio by rolling off some of the investments they've made. Again, we don't know the details yet, but it sounds like they're going to be pretty aggressive. I think that's very difficult to do. They did the 2017 to 2019. They were trying to do both simultaneously. We had a significant disruption in the markets in December of 2018, which brought on the Powell pivot, where he actually turned and started reducing rates. And so, which suggests to me that they're going to have a hard time holding course on this. So I'm very skeptical they can do a soft landing. And again, I don't want to have a continued inflation. It's terrible. It's eroding real wages. On the other hand, I think recession risk is much worse. So I think they should go more slowly than what they're contemplating. The risk of financial disruptions is really too great.